will come through the bond market. I think right now it's unpleasant because the regime has shifted.
I can tell you that there was unanimous concern around the table of the Governing Council about inflation numbers.
2 years ago, I sent an email out saying we think 10-year bond is going to go positive. 3 of my largest contacts in the industry, they insulted me.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. U.S. inflation hits a 40-year high, fueling bets on faster Fed rate hikes, while markets strike a risk-off tone this morning. Some don't like it hot. St. Louis Fed President James Bullard backs a supersized hike, but Fed officials counsel against a half-a-point raise. In UK, GDP rises at the fastest annual pace since World War II, but the British economy suffers a milder than expected hit in December. Now, it's all playing out in the market, so straight to the markets. It's a big market news day. I know some of you wanted a quiet Friday. Not so, because the European stock 600 down some 1%. Now, of course, there is a repricing of Fed hikes. If you look at, the bond sell-off, stocks are also selling off, and investors really worry about that half-a-point U.S. rate hike or even a potential emergency Fed meeting after that hotter-than-expected CPI print. It is putting pressure on technology, of course, extremely sensitive with anything that's going on with interest rates. And you can see NASDAQ futures down some 0.6 of 8%. Look at that flattening yield curve. The 2-10 spreads. I know there has been little movement in today's trading session. We'll see whether, for example, in stocks, there will be buying the dip. Usually it happens. I would suggest, I could be wrong, but in the last 3 weeks, it's always happened on a Friday late afternoon because it's the U.S. buyers that come in. And then crude oil, 90.27. We're expecting, of course, the headline from the Iaea right now crossing the Bloomberg terminal saying OPEC plus a supply shortfall may propel oil prices higher. We talk about backwardation. We'll talk exactly how that filters through inflation. However, if you look at that U.S. CPI print yesterday, a month-on-month, energy was a little bit lower. Now, later this hour, we speak to the IEA's head of oil markets, Toril Bosoni. The European map, it's not one of divergence, but I would suggest that at some point it needs to be when the market maybe gets over that hot print from inflation and becomes a little bit more sophisticated. Of course, the ECB over in Frankfurt is not doing the same thing as the Bank of England, so maybe it will play out on the markets. But for the moment, a blanket of red with the FTSE, the DAX, and even the CAC 40 down between 0.8% and 1%. So global yields up sharply. Traders betting that the Fed will raise rates faster this year. That's after the hottest U.S. inflation print since 1982. The St. Louis Fed President, James Bullard, says he supports raising interest rates by a full percentage point by the start of July. Well, we're now joined by Guillaume Menuet. He's head of EMEA Investment Strategy and Economics at Citi, and our very own markets editor, Christine Aquino. So thank you both for joining us. First of all, Christine, to you, I know we're looking at indicators to maybe tell us that the sell-off has been overdone. What are you looking at?
Well, Francine, I'm looking at real rates in particular. Really will be an indication of whether yields have risen far enough, and more importantly, are they finally compensating investors in lieu of inflation enough that they will finally be enticed back into the bond market and limit that rise in yields that we saw. Now, we haven't really seen, real yields are still negative in most parts of the world, but at the moment, we are seeing a bit of a climb down in yields. The U.S. 10-year yield, for instance, back below 2%. That was a key level, of course, yesterday that we were watching and that we breached, and probably contributing to the pullback in risk assets and stocks that we're seeing in Europe this morning. But we're seeing a little bit of relief there. So perhaps as we get into the U.S. session, we might see a bit of a turnaround in the red that we've seen in the Europe map.
Guillaume, what's your take on what we heard from U.S. CPI yesterday? I know Goldman Sachs had to change their call. They're now expecting 7 hikes in 2022. Has Citi also changed their calls?
I think that the Fed has to be hawkish at this particular point in time. Whether they do 50 in March, I think, is still debatable. They have to deliver some tightening in order to reflect the fact that the U.S. economy is behaving strongly. But I don't think that they want to rush things into meeting. I think that would be the wrong signal to give. So maybe 50 in March, maybe followed by another 50 in the following meeting. But I just worry that the Fed is making a policy mistake if they acknowledge having run the economy too hot. If they are not careful enough and communicate better, they run the risk of damaging the U.S. recovery story.
But Guillaume, at the same time, what they're doing now is actually changing, I guess, perspective on the markets and tightening financial conditions without having to raise rates.
Absolutely. I think they want the market to just tighten for them. And once the pricing is in, it's easy for the Fed to then deliver. But we have every evidence, I think, building gradually that the US economic cycle is maturing, that inflation should start to fade. So you have to be careful about what you do. You can play on short-end rates, but you also have to communicate more clearly about what you do on the balance sheet. Remember, the Fed is still adding assets to its balance sheet. So intermittent move while adding assets to the balance sheet, they have to have a communication epiphany at some stage.
And I guess on the communication, we've also seen other central banks, Riksbank, ECB, with the latest also interview with Christine Lagarde, trying to distance himself from what the Fed. Is there a danger, Christine, that the world, that suddenly every trader, thinks that every region and every central bank were hiking more aggressively?
Well, that certainly was the case, Francine, I think, at the start of February. And now that we're seeing more nuance from the communication in various central banks, I think we're starting to see a little bit of differentiation here. And we were just looking at the desk earlier, for instance, the gap between the U.S. two-year yield in Germany is near 200 basis points, is near the widest since February 2020. And, I think that's the messaging that we heard from ECB's Lagarde overnight, helping keep a lid on European bond yields today and certainly driving that divergence. And so it's going to be really interesting to see, after we got the initial uniform move toward a hawkish stance from most major central banks, now we're seeing that nuance, and now it's going to get interesting in bond markets.
So, Guillaume, is it a problem of communication, or is it a problem that actually central banks are panicking a little bit, want to deal with inflation now, and then they'll see what happens in the second half of the year?
I don't detect a great sense of panic. I think it's a realization that the economy is perhaps performing better than they thought was possible. And if you think about the level of GDP that we see now across the globe, and G10s in particular, compared to pre-pandemic levels, you can't really justify policy rates at emergency levels when real GDP has done so well. So it's about taking away some of the stimulus, but you have to do it in a clever way, and you have to communicate very clearly about what you want to do on the short end and on the balance sheet. And I think this is the reason why markets are still feeling a bit skittish. It's because there's a lack of clear communication about what the Fed reaction function is.
Yeah, I have a great question actually from a viewer. I think Anthony wrote in, and this is a great question which the markets will have to grapple with. So Guillaume, this person writes in saying, how important is today's consumer sentiment print in the U.S.? And he wants specifics on a scale from 1 to 10. What is it?
I'd say it's a high 7 to 8, right? It's clear that if you're the central bank today and you don't get the narrative right, the risk is that you over-tighten and you create expectations of a significant tightening cycle that would then have consequences on the financing costs for the US economy, on the ability of people to effectively get cheap mortgages. So you might effectively precipitate, by not being very clear about your action function, a significant tightening, not only of financial conditions, but also creating expectations of a significant slowdown. So you want to be careful about what you do. Talk about intermittent rate hikes, fine, but what's happening to the balance sheet?
Yeah, I mean, this is a problem that, you're head of EMEA investment strategy and economics, and actually we spend a lot of time, Guillaume, talking about the Fed, but I really want to get your calls as well. Crazy question for a Friday. Christine, do you think that there's going to be dip buying? I mean, if the pattern of what we've seen in the last couple of weeks is anything to go by, we could see it.
Yeah, we could definitely see it, but they're definitely going to be tested in terms of their mettle in buying into these sorts of dips. For what it's worth, I mean, it seems like the pullback in risk sentiment is very much related to just stocks. It's been contained there. We're not seeing the same in bonds. And so perhaps we could see that's enough of a supportive environment for the dip buyers to come in.
Christine, thank you so much. Christine Aquino there, our markets editor. And I'm excited to be asking the head of EMEA investment strategy at Citi what his investment strategy is. So stay tuned with Guillaume shortly. Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we also speak to the Iaea's head of oil markets, Toril Bosoni. Up next, we continue our talk on inflation and investment strategy. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to some of the events that we're watching out for today. At 10:30 a.m. UK time, it's Russia's rate decision. Consensus forecasts point to a 100 basis point rate hike. Now, also this morning, world leaders will gather at the One Ocean Summit in France to make commitments towards combating illegal fishing and reducing plastic pollution. At midday, we're expecting Mexico industrial production data, which likely rose 2.5% in December from the year prior. 3 p.m. UK time, it's U.S. consumer data. The University of Michigan Consumer Sentiment will provide a first glimpse of attitudes as Omicron's economic effects look to be rapidly fading. And finally, today, Bloomberg's Power Player Summit kicks off, bringing together leaders in sport to discuss shifts in the $600 billion global sports business. Now, following that hot U.S. inflation print, here's what some leading voices have been telling Bloomberg TV about the implication for the Fed.
Inflation's going to stay high for a while.
The highest inflation that I've seen.
Companies feel like they have to and can raise prices.
We're going to see pricing that's in the high single-digit range.
There's a lot of pressure on the Fed with the high inflation numbers.
Very substantial rate increases are clearly in store.
The market's pricing in 6 hikes. I think that's fair.
There's a very strong argument for a 50 basis point move at the March meeting.
We'll be watching for how Fed officials talk about 50.
Very clearly a 50% expectation that we're moving 50 with a March Fed liftoff.
They have to significantly restrain demand. And if they don't do that, the inflation will continue to roar.
Well, we're back with Guillaume Meunier, head of EMEA Investment Strategy and Economics at Citi. So, Guillaume, what's your take overall on what you want to be buying into? I know you're quite overweight European equities. Is that because of the differential?
Partly, but it's also because we have a good growth story ahead of us. The U.S. economy is going to be slowing down, I think, quite meaningfully, given the amount of rate hikes that the market is pricing in. Whereas the story in Europe is one of significant caution, I think, from the European Central Bank. They don't have the same inflation fears to allay. They still are going to be buying bonds for the next 6 to 9 months. And if anything, I'd say that cheap money that's going to come through next-gen EU in the next few years could be a significant input into a higher average growth rate for Europe.
So, Guillaume, what does it mean in terms of industry groups that you want to get into? It's very clear that some of the earnings were a good crop, but actually if you disappointed even a touch, you get slammed in terms of share price.
We look at the portfolio. It has to be fixed income and equities. I mean, it's the usual. So we're not just completely focused on equities. Of course, we've been very strongly underweight European government bonds, and it's worked very well. But in terms of the equity segment itself, there are sectors that we like. We like European financials. Obviously, the improving interest rate environment will certainly help here, and we've had some very good stories about European bank recapitalizations. We like the European green energy space, and that's related to what I was saying to you about next-gen EU. After all, the focus is very strong on this on a multi-year basis. It's becoming a political priority, and it's also helping European governments reform and increase potential growth rates. And the other sectors which I think we like is consumer staples, more broadly. But this is done within an overweight of quality. We think that you need to take on risk, but a clever risk as the cycle matures. Mid-cycle is the time where you need to be more selective about the companies, and we like those which have got the strong balance sheets, the high level of free cash flow, and which are not going to be impacted by higher rates.
Yeah, so Guillaume, is it all about pricing power? But if you look at the pricing power, I know there were a couple of concerns, for example, about inventories. So how does that play out in your thinking?
Inventories are gradually, I think, being rebuilt. I don't think that we have the same degree of problems that we had in terms of global supply chains, which were the ones we saw 3-6 months ago. There is greater evidence that the global economy is starting to function a bit more normally. And I would have thought that those companies with pricing power will probably see gradually this slowdown in the rate of increase of intermediate goods prices. So if you can have the right products in the right markets and the right framework around it, that should still be, I think, a good investment strategy to have on the consumer staples as the cycle matures and people want to spend a bit more money.
Guillaume, thank you so much. Guillaume Menuet there, head of EMEA Investment Strategy and Economics at Citi. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Up next, we speak to the IEA's head of oil markets, Toril Bosoni. Send in your questions on IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the IEA says global oil prices could climb further as the OPEC+ coalition struggles to revive production. Now, its report out today says Middle Eastern nations could pump extra crude to ease strain in markets. Well, to discuss this and the latest in the IEA market report, we're delighted to be joined by Toril Bosoni, head of the oil market division at the IEA. Toril, thank you so much for taking the time to speak to us. It's an important, of course, piece of news. Everyone's watching the energy market right now, and it reprices all of the markets. Is the IEA calling today on Saudi Arabia to increase production because, to make up for other OPEC plus members that cannot increase?
Thank you and good morning. What we're seeing in the report today, obviously, the oil market is incredibly tight. Oil prices continue to surge and now reaching levels that are uncomfortable for consumers across the world. Crude prices, product prices, retail prices, 7-year highs. And we think, higher prices causing inflation, risk to economic growth. It's not in the interest of consumers, but not in the interest of producers either. So what we're seeing is that there's capacity for some members of OPEC Plus to increase production further. And if we continue to see strong demand growth in 2022, as we do expect, we see that there's maybe room to adjust the production increases.
Yeah. But Toril, is it really only Saudi Arabia that can increase production at this point? And what are you expecting from OPEC Plus early March?
Well, we're seeing, of course, the OPEC Plus group has been unwinding their production all over 2021, and in 2020, in January, they did increase production. They didn't increase production by as much as the target increase. So now in January, their collective output was 900,000 barrels a day lower than the target. The continued underperformance has taken out 300 million barrels a day of the market, and that's why we have these very tight, one of the reasons we have these very tight inventory levels today. So, of course, spare capacity is majorly held by Saudi Arabia, but the UAE, other producers in OPEC Plus also have some capacity, but it is primarily those countries in the Middle East that are sitting on spare capacity today.
So what would you like to see from OPEC Plus, and do you think that they'll deliver on it?
We'll wait to see. Of course, the OPEC Plus group, they meet once a month. They're going to meet again in early March. If we're seeing oil prices at these levels and the market continuing to tighten, it will be, I think it will be a good idea, will be welcomed by everybody to see that supplies are put on the market to meet the demand for oil. As the economy is still recovering from the COVID, there's a lot of risk going forward. So I think that we will have to wait to see what they do decide.
Toril, what is the IEA doing to prepare in the case Russia invades Ukraine?
Of course, we continue to monitor the market, security of supply for oil, but also increasing for gas, for electricity, other energy sources is at the core mandate of the IEA. So we're looking at options, looking at what can happen. Of course, gas is the primary concern at the moment, as gas prices have been very high. Europe is very reliant on gas from Russia. But of course, Russia is, as the third largest crude producer in the world, the big exporter of crude to Europe, the biggest exporter of crude to Europe, big exporter of product. Oil market also of concern, obviously, and we think that this increased geopolitical risk is also contributing to the higher price levels today. So we're watching. We don't think, as we said in our report, given the importance of Russia as a supplier to Europe, we do hope that the supplies will remain intact.
We're almost running out of time, but given the tightness, would another U.S. release of emergency stocks actually be helpful?
So we're seeing that now countries like the U.S., IEA member countries, have put some oil on the market. There's still some more barrels to come. Not all that oil have been delivered. Of course, this is an option if the market continues to tighten and is putting too much strain on the economy.
Thank you so much, Toril Bosoni, there, head of the oil market division at the IEA, always with some great insight into, of course, some of the tightness and backwardation that we're seeing in the oil markets. Coming up, we look at the UK economy, growing 7.5% in 2021, the fastest annual pace since World War II. Well, we'll bring you the details on the GDP data. Of course, it's from a much lower base, or almost an insignificant base, so we'll look at all of the analysis surrounding that. This is Bloomberg. U.S. inflation hits a 40-year high, fueling bets on faster Fed rate hikes. Markets strike a risk-off tone this morning. Some do not like it hot. St. Louis Fed President James Bullard backs a supersized hike, but Fed officials counsel against a half-a-point raise. And UK GDP rises at the fastest annual pace since World War II. That's as the British economy suffers a milder than expected hit in December. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first of all, let's check in on the markets. And it's very clear when you're looking at the European stocks, NASDAQ futures, that there's a global soul-searching, actually, on what that inflation print in the Fed means for global markets. We're also seeing a bit of pressure, of course, on that flattening yield curve, the 210s, and then crude oil after that IEA report to talk about backwardation because OPEC is just not putting enough barrels on the market at 19.45. I have to say, futures in the U.S. actually extending some of the losses. If you look at what's moving the most, it's really technology stocks, also financials under pressure. So you wonder whether it then stabilizes by the time the U.S. opens or whether we're going to continue with readjustment and free fall for some of these stocks. Now, the UK economy grew 7.5% in 2021, the fastest annual pace since World War II. The annual growth makes up some of the shrinkage which occurred in the first year of the pandemic, where the economy actually dropped some 9.4%. Well, let's bring in our Bloomberg UK economy reporter, Lizzie Burton. Lizzie, thank you so much for joining us. So a lot of people are saying, wow, this is an amazing number. It's a blowout number. But, you know, as you rightly say, the base is so low that I don't know how much of a win this is.
Exactly. We're coming off such a low place from 2020. So it's better to look at the December figure. That's when Omicron hit. And actually, the economy did prove more resilient than expected. Despite the tighter restrictions, higher consumer caution, you still saw a boost to the economy from the vaccine drive, so a boost to healthcare. And then if you look across the fourth quarter, you still had an expansion of 1%, so just shy of the Bank of England's forecast. It keeps the door very much open to a third back-to-back increase in rates in March. And so traders are now seeing 50 basis points of hikes by May, which is a record in the bank's independent history, and also a rise in the key rate to 2% by November. But that's probably a bit more to do with the US news yesterday than this GDP news today.
Yeah, so I wonder how much, you know, the market is really trying to front load this, and the market is looking at the US saying it puts the Bank of England in a tricky spot just because they're behind the curve.
Exactly, which is ironic because it's the Bank of England who's gone first. And it's also ironic because we've had the chief economist Hugh Pill and Andrew Bailey, the governor, saying that they don't want to be guiding markets, and yet this is happening.
But yeah, the BOE like leading the charge actually when it comes to, you know, global hawkishness.
Yes, but given how close we came at the last meeting to the 50 basis point hike, it is certainly on the table.
Lizzie, I mean, if you look longer term at the prospect of the UK, I mean, we don't talk about it that often anymore, but Brexit is also impacting some of the shortages. So what's the longer term prospect for the UK economy?
Well, I don't think that the Brexit picture has changed. It was always going to have a glacial impact on the UK economy, and it's not as big as COVID, but it is there in the trade data this month as well. This impact does just keep on coming.
So longer term, what are we looking at? I mean, how much pressure, for example, does the UK economy, you know, be like in 12 months, 24 months compared to some of the other parts of the world?
Okay, so if we take, first of all, January, you're still going to see a hit from Omicron, but but in the longer term, we're still not back at pre-pandemic levels on a quarterly basis. The US already is. And the Bank of England doesn't see us getting back to that level until the second quarter. That's because of the cost of living crisis. How can we not mention it? It's because inflation's going to rise faster than wages. It's going to peak at 7.25% in April, according to the Bank of England. And so that's the reason why we're going to have GDP held back.
Lizzie, thank you so much. Lizzie Burden there, of course, our UK economy reporter. Now, let's get more on the credit market story. After a spike in yields, investors also repricing risk as the ECB turns hawkish. The big question on their minds now is how much further can spreads move before there's a serious cause for concern in credit? Well, let's get into the rates and credit stories now with our Van Ram. He's our Bloomberg MLive currency and rates strategist, also sometimes psychologist for Francine Lacqua when I need some pointed ideas and questions on what happens to gilts. Back in November, you wrote that the two-year yield had the potential to reach 1.75%. We're now almost there. So what happens to the two-year and the 10-year?
Morning, Francine. Thanks for those kind words. You're exaggerating my contribution. Well, on the 2-10s, if we are going to get 7 rate hikes from the Fed this year, the markets are pricing 6.5 or thereabouts. If we get 7, that's extremely hawkish, and that means that the two-year yield will climb towards 2% territory. On the 10-year, I think we'll go to 220, 225 thereabouts. But the market is at the moment pricing in as much of rate hikes as possible for 2022. And if we have those rate hikes come off later on in the year, then I think there will be a milder correction. But at the moment, we are going to go approach 2% on the 2-year. Francine?
Yeah, so then so this is for treasuries, and I love getting your calls, and I think we'll put them on screen to make sure that it gets to everyone to see. Then we'll get you back to see if you're right again. But what does the ECB's guidance actually, for example, mean for German bunds? There seems to be a lot of confusion on what central banks are actually trying to achieve in terms of communication.
Well, I think that, on the 2-year German curve, I think we will see, at the moment, the 2-year is around minus 35 basis points. I think we will see that approach minus 10 basis points, if not 0, by the end of the year. And on the 10-year German yield, we are around 25 basis points now. We'll go to 50 basis points. And that's something I wrote on the terminal yesterday. Why do I say that? Because the markets are saying we are going to get 50 basis points of rate hikes from the ECB this year. I'm not too sure about 50 basis points, but I think that the way the ECB recanted their policy guidance, I think 25 basis points is eminently doable and a reasonable expectation. Why do I say 25 rather than 50? Because the ECB is even now buying pandemic-related bonds. That's got to end in June, and then the way the sequencing works, the bond purchases end in June, then they give a quarter of a pause, and then they hike rates in the last quarter of this year. And they will really want to see how inflation prints evolve in the second half. So I think that 125 basis point hike is reasonable from here.
Ven, when you look at some of the differentials, is there danger that the markets look at the Fed and say, well, it's going to happen also in my region? So it pushes basically expectations of, a hawkish ECB. And so we're going to see so much more messaging about, if not dovishness, so much more messaging from other central banks around the world so that we don't all lead with the Fed.
Absolutely. I mean, we've already seen that happen with the ECB, and it's going to happen with the BOE as well. The markets are pricing in many more hikes than they were just about a month ago. So I do think that, that puts the impulse of what the Fed doesn't stay in the US. It ripples through to the other G10 markets, and we have seen that happen. However, there are two spots where this isn't quite happening as you would like, and that is in Sweden, where Riksbank came out yesterday to say that, look, we are not going to raise rates before 2024. And with the BOJ yesterday sticking to its yield curve control, that means that the krona and the yen are going to both weaken against the dollar. It is consistent with the call that MLive made at the start of the year that the krona and the yen will weaken.
So, Ven, talk to us about what you're expecting bonds in general and actually stocks to do, and whether the correlation between those comes back to a more normal one.
Absolutely. I do think that with bond yields sticking higher, forward rates sticking higher on the front end, I do think that stocks have to feel the pull of gravity. They can't continue business as normal as they've been in the past 3-4 years since 2018. Per my model and calculations, I think that the S&P 500 will go down to somewhere between 3,900 and 4,100. I'm not saying that will be the bottom, but they will test those levels, I think, based on where we are on the Fed's trajectory. And for NASDAQ 100 to go to 13,450. And I do think that those are big corrections, especially for the NASDAQ 100. But the pricing has been valuations have been extremely lofty and frothy in the past few years. So I think that correction has a bit more to run.
Ven, thank you so much. Ven Ram there, Bloomberg MLive currency and rates strategist. Now, let's also turn to a high-profile hedge fund making a big bet on a sea change in the markets. Gradical Asset Management Asia has ripped up their strategy from the past 10 years as they expect assets that have outperformed to give way to previous laggards. Well, the founder and chief investment officer, Adam Levinson, is a former star trader at hedge fund Fortress, and he spoke exclusively to our colleague, Hazlind Amin.
Our portfolio is basically the anti-portfolio of what was the last 10 years. For the last 10 years, all the flows have been into the U.S. at the expense of the rest of the world, and essentially into U.S. tech. And that's what's obviously vulnerable.
Well, that was the Gradical Asset Management Asia founder and chief investment officer, Adam Levinson there. Now, we have some breaking news crossing the Bloomberg terminal. This is as Hong Kong actually saw some cases top 1,000 again as the record outbreak is growing. Again, because of the zero COVID tolerance policy, they're dealing with it in a very different way to what we are here in Europe or even in the U.S. Hong Kong are now currently saying they will extend flight bans on places including the U.S. and the U.K. to March 4th. Coming up, things could go crazy quickly in Ukraine. That's according to Joe Biden. More on the tensions at the border with Russia shortly. This is Bloomberg.
It is a headache, of course, and it worries people not only in Austria but all over the world a lot. And I think we have to be serious and take the worry seriously. But what can you do? I mean, it is supply side driven, of course, and very much driven by energy prices, of course. So a national finance minister can't do a lot because it's a geopolitical question, of course, especially the energy prices, an international question. What we can do within a member country is loosen the burden for the people, energy prices, and so we're doing a lot of things there. And we just had a big tax reform, which also is a big tax relief for our citizens.
So, Minister, if you look at some of the subsidies that your country is putting in place, that other European countries are putting in place to alleviate some of the consumers because of higher energy prices, how long are you expecting these to last?
Well, what we did now is, as I said, is the energy prices, which are very high, and we subsidize those a little bit. Actually, almost the same amount as in the UK, with 150 euros for everyone, for all the households, and 300 euros for the ones who don't earn a lot. So there's a mixture of those subsidies. And as I said, we have a tax reform, and that's probably the biggest relief for all our citizens.
So when are you expecting inflation to come down? Could we see higher energy prices for the next couple of quarters?
I don't think so, actually. I think inflation will be still high until, let's say, the next 2 months, I would say, 3 months. And then hopefully we see sort of going down a little bit. That's at least what all the experts tell us and what the ECB tells us. And it's the competence of the ECB, of course, to take measures.
How tolerant should you be of what the ECB's measures have been so far, given also some of the forecasts that were actually proven to be wrong?
Well, not all forecasts have proven to be wrong, but some of them, yes. And it's a difficult time, actually, and all forecasts are not very easy to make. So, but I think within the middle of the year, I think we can expect the inflation going down a little bit, at least, maybe not to the amount we had in the past.
Well, that was Austria's Finance Minister Magnus Brunner talking to us a bit earlier on. Now, stocks extending declines on Friday, especially in U.S. futures. If we bring the board up, we don't know whether there's dip buying suddenly. It could happen as we get into the U.S. Open, but this time it also feels different because of that huge, Federal Reserve interest rate hike being priced because of the U.S. inflation yesterday. Now, sell-off in sovereign bonds easing with the 10-year Treasury yield actually falling about 4 basis points to below 2%. The 2-year yield little changed, but bonds across Europe mixed, with Germany's 10-year yield actually dropping 2 basis points. The dollar rising, commodities-linked currencies sliding, and then the pound on the back of that GDP figure, the pound erasing a decline after data actually showed that the UK economy expanded at the fastest pace since World War II last year. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Vodafone has rejected a $13 billion offer for its Italian unit from a consortium including Iliad and Apex partners. The British carrier says the offer is not in the best interests of its shareholders, with sources telling us it sees it as too low. Iliad says it is pursuing a standalone strategy, suggesting it will not increase its bid. Now, Affirm shares plunged after the buy now, pay later firm whipsawed investors with an errant early release of partial financial results and then a forecast for disappointing quarterly revenue. Just hours earlier, investors were given a snapshot of what the US company called another great quarter via an accidental tweet. And SpaceX founder Elon Musk says US regulators may grant approval to its South Texas site as soon as next month, paving the way for the launch of Starship this year. Speaking with the 390-foot Mars spacecraft as a backdrop, Musk said he is highly confident Starship will make it into orbit this year. And that's your Bloomberg Business Flash. We could be reporting from Mars soon, Francine.
We could. We could also be chasing for an Elon Musk interview, which we are. So if you're listening, Elon, now's the time to come and speak on Bloomberg Surveillance.
Should we both tweet him together? I know he's originally from South Africa, so I thought of doing something creative with a space rocket in the middle of some South African amazing. I don't know. You think about it.
I may or may not have a meme actually to ask for an interview that our wonderful producer in Dubai, Greg Tanner, put together. So that is going up shortly.
He is the king of memes, Greg Tanner, just to put that out there.
It certainly is. So now we need an interview. Leanne, thank you. Now, despite rampant global inflation, supply chain problems, and a semiconductor shortage, the rebound in the luxury market has been swift. Tag Heuer has unveiled its latest luxury watch, and the question on everyone's minds: how quickly will we see price hikes in the sector? Well, the Tag Heuer chief executive, Frédéric Arnault, spoke to us earlier.
First of all, luxury watches and luxury goods overall had very strong demand before the pandemic. With the pandemic, it grew because there was a big trend before of experiential luxury, investing, spending for travel, restaurants, hotels, and this, of course, was heavily impacted and is still very low and not back yet to the level of 2019, and certainly not to the expectations people had then. However, the economy is doing very well. The purchasing power is still high, especially in the two strongest markets for luxury goods, which are the United States and China. And so people had a strong appeal for spending on the luxury goods. If we look on watches, there is one other strong dynamic, which is the investment value. And this is brand has been investing a lot on that, making sure that icons keep their value over time. And then when you purchase a watch at retail price, actually it will resell for a higher price point. And so people invest in watches a lot, and so they see that as a store of value for some icons. And this is the case also for Tag Heuer. We are seeing this dynamic on a watch such as the Monaco, which you cannot find easily today, and on which we have a strong wait list.
Well, that was the Tag Heuer chief executive, Frédéric Arnault, speaking to us earlier today. Now, coming up, President Biden warns things could go crazy quickly in Ukraine. Well, that story up next. This is Bloomberg.
American citizens should leave now. We're dealing with one of the largest armies in the world. This is a very different situation, and things could go crazy quickly. They're not. That's a world war. When Americans and Russians start shooting at one another, we're in a very different world than we've ever been in.
Well, President Joe Biden there urging U.S. citizens to leave Ukraine, saying things could go crazy quickly. Now, the U.S. reasserted its intention to impose swift and severe costs on Russia if the Kremlin takes any aggressive acts. Now, we're joined by Mark Champion, who, of course, is, has insider knowledge of the situation, but also just came back from Kiev. I think you were on a road trip there, Mark, to try and understand really what was happening on the ground. So, first of all, Mark, what do we understand is the intention of Vladimir Putin right now?
Okay, well, the first thing to say is that none of us know. Biden said he doesn't know. The people that I talked to in Russia who are well connected to the Kremlin, they say they don't know. And, it's quite possible that Putin hasn't decided yet what he wants to do. But what we do know is that his goal, how he wants to get it, we don't know. But his goal, we do kind of know. He wants to rewrite the security architecture in Europe in such a way that, countries like Ukraine don't actually get to do exactly what they want, to join NATO, to join the EU, etc. That Russia gets a strong say in that.
So how are the allies actually, reacting to this? I know there was talk about him doing this also to fracture some of the allies and fracture, nations within NATO. What do you make of what Biden was saying? It seems like everyone's more on the same page.
Yes, I mean, one thing that the U.S. response has been to really play this up and to say, just like he was then, just to say, this is a very real threat. It could happen at any moment. It would be, the largest war in Europe since 1945. So to really play it up, and that has actually made it so that it was possible to get a level of unity among the NATO allies in Europe and so on, and also to get some weapons, further weapons to the Ukrainians, defensive weapons like anti-tank weapons and so on. So that has actually played a role, yes.
Mark, I mean, we also have the story yesterday was this massive drill in Belarus with these military exercises. Yep. Again, how should the West interpret that and react to that?
It's, again, I mean, it is, so the interesting thing about this is that, the U.S. has said we should be really worried about February the 20th. And the reason that is really some signaling from the Russians, so that they basically said, we're going to have these exercises. NATO says it's about 30,000 troops. That's a lot of troops. Yep. And that's going to take place. It just began, and it will continue till the 20th. Mm-hmm. Then they have exercises in the Black Sea, which have just started. Those are going to go on for a while. Also, it's a very impressive map. If you look at it, what the zones where they say they're going to do these things, it would be, it would be exactly what they would do if there was a war.
All right, Mark, thank you so much. Of course, Mark Champion there from Bloomberg, and we'll have plenty more from Mark in the weeks to come. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller in New York, Anna Edwards Anna Edwards, Danny Berger in London, and our Matt Miller is in New York. I'm getting confused with the time zones, but it's going to be a great show, so tune in. They talk about inflation, they talk about bonds, futures extending losses in the U.S. This is Bloomberg.
I don't know that anybody really prospers in an inflationary environment.
Live with it being a little bit worse, because I think by the end of the year, it'll be quite a bit better.
The market is assuming or pricing that this is all a rate hike story. And we just don't think it's going to be quite that simple.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, February 11th. Our top stories today. Global bond yields are soaring today. Traders are betting the Fed will raise interest rates 7 times this year to contain inflation that is set a new 4-decade high in the United States. Joe Biden's wake-up call, the inflation report, has made the president's fight to enact his spending plan and keep control of Congress that much harder. And the Super Bowl may not be the only thing to kick off this Sunday. There's concern that those trucker protests could spread to the United States this weekend and end up in Washington early next month. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Matt Miller in New York. Kailey Leinz is off today. Danny, welcome to the program. Matt, certainly that was the story of yesterday, wasn't it? That we saw bond markets really heavily selling off. We saw yields going higher, Matt. But in fact, maybe Danny, maybe I'm coming to you on this one, so get ready. But today we seem to be pausing a little bit in that bond market narrative. No, I am going to, Matt, to work out exactly where we go next here, Matt, because it's interesting to see the bond markets pausing a little bit in that rate hiking expectation. But boy, have we come a long way in the last 24 hours. Don't hear Matt Miller. So this is what I feared. We'll go to Danny instead.
See, your first inclination was maybe right, Anna.
Absolutely, absolutely. I mean, that's what we're seeing, though, isn't it, Danny? We've got equity markets spending another day in the doldrums. Equity markets really to the downside here in Europe. Yesterday, we closed pretty flat in the European session. But today we don't have necessarily that cushion of earnings to fall back on. Maybe that was providing a little bit of a comfort blanket yesterday. And today we see some quite severe losses for European equity markets. More on the Europe in a moment. Maybe you could get to the US story.
Exactly. Well, European equity is down more than 1%. But Anna, let me show you what's happening pre-market in the US. We are down only 0.5%. Most of the moves happened yesterday. We had this idea it could be 50 basis points. Perhaps it is an intra-meeting move as well. So that sent stocks lower more than 1% yesterday, more than 2% for the NASDAQ 100. We are seeing bond yields drop a little bit, down about 2 basis points. We are still at that 2% level. Is convexity hedging, is that the next fear we have to watch out for? 2-year yields, though, those are still pushing higher, just under 1 basis point. And, of course, Bitcoin is in here because Matt checks Bitcoin every day, so I will do it for him. Anna, it is down 0.7%, often a good barometer for overall risk appetite.
We heard him. Matt Miller, you are there.
I'm
All
glad.
it took was mention of Bitcoin, and his voice is once again audible.
Yeah, well, look, I think there's an interesting watch on bond yields today because they did definitely soar yesterday. We saw amazing moves in the 2-year yields, and we're seeing some pretty amazing moves in 2-year yields today across the globe, but just not in the U.S. We saw a real flattening of the curve, which I think is interesting, and I see you're going to talk about Volvo, which I'm excited about. You talked to my man over at Volvo, Samuelson.
Yeah, Hakan Samuelson. He's not going to be there very much longer, handing over the reins of that business. But I did talk to him, and that was an interesting conversation. And let me check some European assets for you, and that is part of that of what I wanted to mention, actually. We do still seem to be stuck in yesterday's groove as far as stocks are concerned, so that's where we are seeing that higher interest rate narrative certainly being reflected in that angst around the TINA argument. Does that there is no alternative argument still support stocks in a world where bond yields are rising? That's the question we were dealing with yesterday. Continue to deal with that today. But as you rightly point out, on bond markets, we paused in our narrative from yesterday. Bonds were totally pummeled yesterday, of course. Yields were soaring, but that tantrum easing a little bit today. We were at 0.3% on the German 10-year Bund. Where are we right now? We're at 0.27. So that is where we are seeing some of those yields coming down. That is the latest development on the bond market story. Some of that move to the upside yesterday being unwound. And here, the European dimension, Christine Lagarde at the ECB warning that if they act too hastily, they could hurt the economy. And that's something we're watching, of course. In the UK, pricing in further hikes from the Bank of England. We've seen an earlier loss on the pound, entirely unwound on the fact that we're now pricing in 75 basis points of hikes by May. That would include then a 50 basis point hike at some point in the next 2 meetings, which is what has got the market's attention. And Volvo Cars in there for you, Matt. Down by 4.7%. Supply chains in focus. Visibility really low, it would seem, on the supply chain story when it comes to the auto sector. Danny.
Oh, Matt, and almost rubbing it in Matt's face. You did Volvo today and not him. Look, with much of earnings behind us for the day it is Friday, we tend to see less earnings. Let's take a look at what else is ahead today, mostly on the more macro scale. We're going to get Russia rate decision at 5:30 a.m. New York time. They're set to raise by estimates a full percentage point. So maybe we do get that 50-plus basis point move somewhere in Europe today. It is also the Bloomberg Power Players Summit for leaders in the global sport business. Guests include CEOs of DraftKings, FanDuel, and Crypto.com. And we'll get U.S. consumer sentiment data at 10 a.m. New York time. Matt, just how worried is the consumer about inflation?
Yeah, well, pretty worried, I would say, but we'll definitely get a data readout on that. Jim Bullard is worried. He's calling for accelerating rate hikes after the U.S. saw its hottest inflation reading in 4 decades. well, we keep seeing the hottest reading in 4 decades, but it was even higher. The St. Louis Fed president says he'd like to see a full percentage point lift by July 1st. So before we get to July, Kriti Gupta, Bloomberg Markets correspondent, joins us with the latest. Kriti?
Yeah, one of the big conversations that's happening right now is what's being priced into the curve, right? Because James Bullard coming out and making those pretty hawkish calls, and he's actually seen as someone who's fairly ahead of consensus sometimes. He makes these really big calls, but then they kind of come to fruition. So the market takes what he says very seriously. But the caveat here is that if you do kind of front load hikes and you do it by a pretty big margin, he's saying 1% by July, essentially 1% worth of rate hikes by July.
Basically 4 over 3 meetings.
Essentially. So it kind of requires that if we're going by 25-point margins, basically at some point you do have to have a 50 basis point hike at some point. But what that does is it also brings forward the curve. So I think we have a terminal chart here, and for our radio audience, don't worry, I will explain it. You do have the
By the way, they could
euro-dollar
do
curve.
33 1/3 at each meeting.
That's come on. He's made that joke like 5 times in the last 24 hours.
Once!
But the euro-dollar curve is really what's interesting to me. Basically, it's saying that the spread between the December 2023 and 2024 contracts, basically, they're actually turning negative. It indicates that a rate cut might actually come sooner than expected. It might come in just shy of 2 years. So once again, it tells you if you're front-loading these hikes, perhaps in 2022, that means that perhaps you're also bringing forward some of those recession calls.
I do think the ECB hikes in 10 basis point increments, so maybe that's more likely to get around 33.
Yeah.
I don't know what the math is there. But anyway, speaking of which, Kriti, we did have ECB President Christine Lagarde saying that rushing to tighten monetary policy threatens to choke off the recovery. To what degree is that gradualism priced into the market?
Yeah, well, it's interesting that you say that because it's such a kind of stark contrast to what you're seeing in the United States, where it's turning into let's kind of price in more and more cuts. That's something you're seeing in emerging markets as well. You mentioned the Russia rate decision that's coming out shortly, but the ECB is a completely different story, and I think the best kind of gauge of that is what's happening with the euro relative to what's happening with the pound. Because if you compared those two central banks, the BOE, which has of course had that very hawkish pivot, and of course that recent hike that is largely priced into the markets, well, the ECB is just now warming up to the idea of kind of addressing inflation, but doing it gradually creates a little bit of a ball in Lagarde's court, and the idea that it's really up to the euro in terms of what all those European currencies do. And a lot of that hangs on to basically every word that President Lagarde says.
Yeah, and if you're looking to express that strong dollar view, you do it versus the euro today, Kriti, to your point, down by 0.4% on euro dollar, the pound pretty unmoved. Kriti Gupta, thank you very much for your thoughts on the markets. Now, what does this inflation mean politically? President Biden faces an even bigger battle to enact his spending proposals and retain his party's control of Congress following the January inflation report. It showed an unexpectedly large surge in the cost of living for Americans. Emily Wilkins, Bloomberg government reporter, joins us now from DC. What kind of, I don't want to call it a wake-up call on inflation. I was tempted to, Emily, but that would be to suggest that they didn't see it coming or that nobody had talked about inflation before. And of course we have. Politically, how does this kind of number, 7.5%, go down?
For the number that we saw, it's really just sort of entrenched everyone's current positions. You've seen Senator Joe Manchin, the key Democrat, who's really sort of seen as holding back the president's agenda, come out and say that he was kind of right all along. He was worried about inflation. He remains worried about inflation, and he doesn't think now is the time to move a spending bill. And yet we saw President Biden visiting Virginia yesterday, going to what's going to be a very difficult district for Democrats to hold on to, and saying, yes, there are still aspects of this bill that are needed. If inflation is going up, if food prices are going up, then the government needs to do things to bring down prices in other places, such as childcare, prescription drugs. And so it doesn't really seem like these numbers that are coming out are really budging other side off of their positions. Everyone's kind of doubling down. The administration's saying that this legislation is needed, and Manchin saying that everyone needs to slow down a bit here.
Yeah, so I guess it's super dead. I heard it described as super dead, Build Back Better today because of Joe Manchin. Are we going to see any kind of, child tax credit or SALT relief?
I mean, that's the big question right now. Lawmakers are saying, look, Manchin does support certain aspects of the Build Back Better. Does he support the entire thing? No, but could we move something smaller? And that's really been the discussion in Washington. The thing is that we haven't seen any negotiations. We haven't seen any progress being made. It seems like Congress has been more focused on a number of other issues, a number of other pieces of legislation, and we really don't have any indication that Democrats are moving forward on a smaller piece of the Build Back Better bill. And let's be clear, they're running out of time here. I mean, for the first primaries start next month, and then in May is when the election season really kicks off. It is difficult to move legislation in an election year, particularly so with a bill as big as this one.
Emily, thanks very much. Emily Wilkins there, of Bloomberg Government out of Washington. Now, it is Super Bowl Sunday coming up. It could mark the start of trucker protests in the U.S. Homeland Security has warned police that drivers opposed to vaccine rules could begin their protests on the day of the big game and drive across the country to Washington by early next month. This Sunday's game will be unusual in a number of ways. Wings, as we tell you every year, they're going to be pricey. Seats, too, are expensive. Obviously, $7,500 is the average, so it's very high. And there are very high stakes for the game. 100 million Americans are able now to legally bet on it for the first time. Let's get more with Alex Webb, who covers tech, media, and telecoms for Bloomberg Quick Take. So, Alex, what are we expecting first as far as the big game and the big betting?
Well, as you say, it is the first time that betting is legal in a huge number of states. Going to have 100 million people able to bet. The NFL over the next decade thinks that it could be worth the betting market $1 billion to the league. So it's clearly big business and something to which they were averse for a long time. And the thing that's most remarkable, I think, is that after a decade of really declining audiences in the league, we're really starting to see an increase. Now, the question is that a one-off, or is it something that's more sustainable?
I have to say I would definitely, or not definitely, but I would definitely consider spending $7,500 to see Snoop Dogg and Mary J. Blige. I definitely consider
it. Is it essentially a concert?
Danny had a good
yes.
annual review,
Okay.
clearly.
Yes.
I thought there was sport involved.
And it's the sideshow.
Okay.
But speaking of which, I mean, you have people watching the halftime show and the sports, wide audience, so people want to pay up to have advertising during the Super Bowl. We've seen inflation everywhere else. Is there inflation when it comes to paying up for ads to show up on NBC?
The irony is that even as audiences were declining, the value of ads always increased. And it's because you get very few tentpole events these days that everyone watches. You don't get those water cooler chats about TV. You don't have 25 million people watching Cheers every Thursday or whatever it might be. You do get it with big sporting events, and the Super Bowl is the biggest, so that's why it's so valuable.
Okay.
Alex, thank you very much. That is Bloomberg's Alex Webb on all things Super Bowl gambling and advertising. Now let's get a look at some of the stocks moving in the U.S. pre-market, starting with Zillow that reported earnings yesterday. 13% move pre-market. The shares had wiped out about $35 billion in market value last year when they announced that they'd be winding down that automated home flipping service. Zillow yesterday on the call saying that they were moving quicker with winding that down, also developing something called a super app for housing to help people buy and sell housing. But those ambitious targets getting the market exciting. DD to the downside this morning, however, of course, the U.S. ADR. It had rallied yesterday after some filings that we saw Tencent taking a big stake in Didi. Well, Tencent coming out today saying that actually that stake was part of what they purchased in an IPO. They had subscribed to more shares in the IPO, so it wasn't new. So some of those gains giving back 5%. And finally, Affirm. This is a buy now, pay later firm. And a little bit of strangeness yesterday. They had accidentally tweeted their earnings early yesterday, along with the text, a strong quarter for us. Unfortunately, Wall Street did not think it was a strong quarter. Sent shares down 23% at times, triggering a circuit breaker. They apologized that it was human error that they released those earnings early. Still, they released earnings, and the market is still not happy. Pre-market today down 9%. Anna, this really just affirms my view that being a social media manager is one of the most high-risk jobs you can have.
Absolutely, absolutely. Step away. That yes. Step away from the keyboard. Right. Next up on the program, we will talk about the rising rates environment. Alberto Gallo, Algebris portfolio manager and head of macro strategies, joins us. How far is the Fed going to go, and how fast, and what damage will that do, if any, to the U.S. economy? Or will it be good for the U.S. economy? Do they need to get on top of this big inflation? And on the truck disruption, in Canada. We will talk to Craig Fuller, CEO of the transportation and supply chain data firm FreightWaves. This is becoming something of an international phenomenon. We'll talk to him about that. Plus, a record year for global sales, part of our interview with the Ducati North America CEO, Jason Chinnock. You see him there talking to Matt Miller. Matt looks like he's having a terrible time. We will get to that conversation later. This is Bloomberg.
Welcome back to Bloomberg Surveillance. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller. Normally I'm here with Kailey Leinz, but she has the day off today. Danny Berger has kindly filled in for her out of London with Anna Edwards. Now, we are looking at rate hikes or rate hike expectations because of what James Bullard said yesterday, and that was because of the inflation figure that we got. 7.5% in CPI growth in January is the most we've seen since 1981. Now, as a result, the market is pricing in almost 5 rate hikes by July. So that's 5 rate hikes of 25 basis points apiece, if you consider that that's what the Fed typically does. But the market's also pricing in almost 2 for March. That would mean basically a 50 basis point hike. If you believe that this Fed is capable of doing that, that would make sense. Joining us now is Donna El-Paldagi, Bloomberg managing editor for credit. And Donna, what we want to know is these increased expectations, these high inflation numbers, what kind of effect do they have on the corporate credit market?
Oh, it's having an effect on absolutely everything. We're seeing spreads blowing out. We're seeing the cost of funding in the actual primary market blowing out. We're also seeing it across assets. It's not just in the credit world. It's also in stocks. And of course, it's in FX rates, too. I mean, this is basically a complete shift in the paradigm. And what's really important here is that even though we saw the benchmark U.S. yield rise above 2%, it didn't just pop up and pop back down. It's still up there. And that basically tells you that there is this massive shift and people are starting to price that in for real.
Yeah, it is flirting with that 2% line. It keeps going sort of up above it and dropping down a little, but I absolutely, your point is valid. It is still around 2%. We have not substantially dropped back. What about the European angle on this and the fact that the ECB owns so much corporate debt and has been so active in that market? A little bit more, I'm told, than other central banks. So what they say in March about their approach to supporting the economy on that front is going to be crucial.
Absolutely, and I think everyone's going to be looking to that meeting just to see how much of a support that market is going to actually get. However, the problem is that people don't think that the ECB can by itself withstand the sort of, wave that we're seeing worldwide. If the Fed moves and the BOE moves, can the ECB just be calm? And I think a lot of people don't think it can.
Yeah, absolutely. They do seem to be on slightly different paths at the moment, but at least the ECB has turned from its more dovish to a little bit less so. Thanks very much to Bloomberg's Donna El-Paldagi, who joins us to talk about credit markets. For more market analysis, check out MLIV Go on the terminal. Fantastic blog from the Markets Live team. MLIV, that is the function. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Matt Miller in New York. Kailey Leinz is off today. Now let's get to your first word news. President Biden is warning U.S. citizens to leave Ukraine quickly. In an interview with NBC News, the president said, quote, things could go crazy quickly. He also said there's no circumstance in which he might send U.S. troops into Ukraine to help Americans flee. Russia has repeatedly denied assertions that it's planning to invade Ukraine. Members of the billionaire Sackler family that own Purdue Pharma are trying to get that opioid settlement back on track. Bloomberg learned they're considering whether to add $1 billion to the agreement in an effort to win over holdouts. That would bring the family's contribution to $5.3 billion. A group of state attorneys general opposes the deal, and a judge rejected an earlier version. SpaceX founder Elon Musk says he's highly confident his new Starship will be ready for launch this year. Musk spoke at the event in Texas, with the aircraft providing a dramatic backdrop. Musk says he may get regulatory approval in a couple of months. He envisions that one day Starship will carry people to Mars. And Matt, I read one day there may be 3 trips a day to Mars.
Yeah,
which sounds terribly convenient.
The system is designed to carry 100 passengers, which I think is pretty awesome. I would definitely sign up for that. Coming up, Alberto Gallo. We'll ask him if he wants to go to This is Bloomberg.
Welcome back. This is Bloomberg Surveillance Early Edition. This is what you need to know. Traders are betting on big interest rate hikes by the Federal Reserve by the end of the year, on the back of the U.S. inflation print of 7.5% this week. Economists at Goldman Sachs now expect the Fed to raise rates 7 times this year, up from the 5 hikes they had seen earlier. Inflation could put a damper on 2 of President Biden's key issues, passing his spending plan and retaining control of Congress. Republicans are blaming Democrats' spending for the jump in the cost of living. And the Super Bowl may not be the only thing that's kicking off this Sunday. There's concern that those trucker protests in Canada could spread to the US this weekend and end up in Washington early next month. It's still not clear how serious the threat is, but Homeland Security has warned law enforcement agencies to be ready. That is a look at what we are watching this morning, what you need to know. Matt, what are you watching ahead of the US Open?
Well, I'm paying really close attention to the spread, and I'm going to show you that in a second, the 2's10 spread. But here's the U.S. futures right now. S&P futures down 0.5%. We had a rough day yesterday. If you were long, right? If you were short the market, it was great. The S&P was down 1.8%. Right now, you can see the 10-year yield coming down a little, but still at basically 2%, one spot 9979. The 2-year yield continues to climb. Yesterday was amazing what we saw in the 2-year yield. I think at one point it was up 20 basis points in the session. One spot 5918 is what we're looking at right now. Bitcoin not doing a heck of a lot. It's back down to 43,300, but yesterday we saw it up around 45,000 for a bit. So maybe a little action to the downside, but relative to what we've seen the past few weeks, it's still holding pretty tight. Take a look at the spread right now between the 2s and the 10s. We've come down. The yield curve has flattened, so to speak, down to 40. We haven't seen that since 2020, which seems so long ago. And the problem is a yield curve flattening like this, even inverting, implies that we're going to have real problems economically. And that's something the Fed, I think, watches very closely. Danny, what are you watching in terms of pre-market movers?
So, yeah, that's the macro. Let me dig into the micro. Zillow, one of the biggest stocks moving up pre-market in the U.S. Those shares up more than 13%. They reported earnings after the bell yesterday. Zillow has had a tough run of it since they announced they were winding down that app that would automatically flip houses. They lost some $35 billion in market value. They did say that they are ahead of schedule to wind down that feature. Also looking at a positive outlook, ambitious targets, including a new super housing app. Didi, the U.S.-listed firm, Asia firm, rather, Chinese firm, is falling about 5% so far this morning. It had a pretty sizable gain yesterday on news that Tencent had taken a new stake in it. This was according to a filing, but it turns out that stake actually isn't new. Tencent spokespeople saying today that it was something that they had added on during the IPO. They had subscribed to additional shares. So it's actually not new. So some of that optimism giving back. Finally, Affirm Holdings, a rather unfortunate story for this buy now, pay later fund. They had accidentally put a snapshot of their earnings out on Twitter during the middle of the day yesterday. They weren't set to report until after the bell. They also said the text along with that tweet, a great quarter, and unfortunately the markets did not think it was a great quarter. So it fell as much as 21% yesterday, halting the stock. We continue to see it drop even more. Pre-market down 10%, Anna, and we had some in the firm saying that it was due to human error.
Right, yeah. Tweet first, apologise later then, perhaps the name of the game. Yes. There. Let us tell you what is going on here in Europe. Let me get to some European assets for you. And European equity markets moving quite strongly to the downside. So once again, another another day where we seem to be caught in yesterday's theme, although it is very much the dominant theme. European equity markets moving to the downside, down by 1%. And this all has to do with our concern that maybe the TINA narrative that has supported stocks so well over recent years and months, maybe that doesn't do so well if we see interest rates firmly on the rise. With that in mind, how much will interest rates firmly be on the rise here in Europe? Well, Christine Lagarde at the ECB pushing back on the market's expectations of higher interest rates in the short term, saying if they go too fast, that will damage the European economy. And so hence the difference, I suppose, the different stories being told by certainly Bullard at the Fed and Christine Lagarde, illustrated by the euro dollar there, and a big move, 0.3%, although it is broadly a dollar strength story. We also have Volvo Cars in 4.7% to the downside. Supply chain's really an issue. We'll play you a little clip of that interview I did with the CEO at Volvo Cars a little bit later on. And we also put the ruble in here, not seeing a great deal of movement because we've just heard exactly what we expected to hear from the Russian central bank. They have raised their key rate to 9.5%. They raised it by 1%, 100 basis points. That's the cut. That's the way the Russians do rate hikes. We've seen 3 of those. That's the 3rd one they've done in less than a year. The ruble at around 75 to the dollar, of course, pre the decision, and still remains in around that range. The weakness in the ruble obviously damages the inflation story into the future because it means that imports are more expensive, and that is something, of course, the central bank very mindful of. Matt.
All right, so let's talk a little bit more about rate hikes, not necessarily in Russia, but what we heard from Jim Bullard yesterday was pretty interesting. Alberto Gallo joins us now, head of macro strategies and portfolio manager for Algebris Global Credit Opportunities Fund. And Alberto, I mean, you know, the market has been expecting a lot of rate hikes, and Jim Bullard is not a dove. Nonetheless, he says he wants to see 4 rate hikes over the next 3 meetings, if you consider each one a 25 basis point move, which means at some point we've got to get 50, as Kriti was telling us a little bit earlier. Does that change your strategy at all, or did you expect that?
Good morning.
Morning.
Here, central bankers are behind the curve, so they have 2 options. One of them is to keep being hawkish, try to fight inflation, and at some point that's going to push risk assets down. It's going to push stocks lower and spreads wider. The other option, which is what the ECB is doing, is to wait and try to push back against the expectations of higher rates, but then you risk losing control of the long end of the curve. You risk losing control of inflation expectations. So they're really stuck in a tough situation. They waited for too long. They didn't push on the brakes last year. Now they have the option of slamming on the brakes, but some people will be pushed out of the windshield.
Okay,
well,
right.
Okay,
that's a painful sounding metaphor. Yeah, go ahead. Any change in your expectations based on that CPI print?
We are prepared. We've been calling for inflation being persistent since 2021, and we are very short on duration. We've been particularly worried about the short end of the U.S. Treasury curve. We think the curve is going to invert. Today we saw a 7-10-year inversion in U.S. Treasuries. But even in Europe, where the ECB is digging their heels, Madame Lagarde is digging her heels against inflation, you know, we think that the consensus in Frankfurt is dwindling. There is very few governing council members that are hawkish, that are dovish, and there's a lot more that are hawkish. Only, you know, the president, the chief economist, and maybe another 1 or 2 are dovish. So even the ECB will have to make a tack, to make a change and become more hawkish, and that's a lot of widening for periphery spreads. Think about Spain, think about Portugal, and so on.
Yeah, sure. Interestingly, of course, Christine Lagarde pushing back on that suggestion, suggesting that if they act too quickly, that they would damage the economy. If I could take us back to the US with that in mind, we now see markets pricing in a rate cut in 2024. Do you think that we get to a point where the Fed hikes so much that we end up as soon as 2024 in a rate cutting cycle, Alberto?
It's a very tough question. At the moment, what markets are pricing in is that the economy cannot sustain a very high terminal rate. Now, this is all about expectations, and you have to look at 2 things: the house prices and rents on the one hand, and wages on the other. We've seen some pretty staggering wage data from the Atlanta Fed tracker, you know, above 5% year-on-year growth. Let's remember that wages, real wages, have not really been growing for the last 20, 30 years in the US. people had more leverage. They could buy cheaper flat screen TVs from China. This is no longer possible. There is a lot of inequality. The tides of politics are changing, and so there is a demand for higher real wages. So we might as well see that inflation doesn't go back to 3 or 3.5 at the end of this year, and there is a stickier inflation that persists in the coming years, and which means the Fed will have
Alberto,
to choose.
I do have to wonder. Sorry, I just want to.
Yeah.
Go ahead, Alberto. The Fed will have to choose between
inflation and asset prices. So
well,
far,
Alberto,
the Fed
it seems that the Fed has been really willing. Exactly, the Fed has been willing not to exercise that put. It seems that that is not where their concentration is at this moment. But as we start to see a widening of credit spreads, is there a point that that in itself could cause the Fed to exercise that put?
Yeah, that is the danger, is that you start inflicting damage on the recovery. And that also is something the Fed does not want to do. At the moment, we are at around 65, 70 basis points on investment grade credit spreads. In 2020, they were over 100 basis points. That's when the Fed started to buy corporate debt and the fallen angels bonds. So, we still have some room. If you look at the S&P, yes, it was down, but markets are actually reacting in a relatively orderly fashion so far. We think that will change. We think that central banks are panicking around inflation, and they might make a policy mistake. So they might fall into the opposite direction, the opposite mistake that they were doing last year. So from being too dovish to being too hawkish. And so there might be a bit more widening in credit spreads. It is a cycle. It is a cycle that will be adjusted. But in the meantime, we are looking at central banks realizing they're behind the curve, panicking, and eventually pushing spreads wider, as well as interest rates in the short part of the curve.
Okay, it's interesting you mentioned spreads widening. We're just seeing Italian bonds extending their slide, 10-year yield jumping there 5 basis points to 1.94%. We watched the spread over the Bund, of course, on that front. Alberto, thank you. Alberto Gallo, head of macro strategies and portfolio manager for Algebris Global Credit Opportunities Fund. Really good to speak to Alberto today. Coming up on the program, Canada's trucker protests spread. We will discuss the impact on supply chains with Craig Fuller, CEO of transportation and supply chain data firm FreightWaves. This is Bloomberg.
It's the highest inflation that I've seen. We're going to see pricing that's in the high single-digit range.
The economy is doing very well. The purchasing power is still high.
The reality of the way that people are buying now is that they're not necessarily financing. People are buying with cash. And that has been something that's quite interesting to see.
The volumes are not growing as we would like. So we have been compensating that. And you could call that almost also, of course, a sort of inflation. I mean, raw material is going up, and then we increase the prices.
Some of our top guests there discussing inflation over the last day or so. Inflation and supply chain concerns, clearly something I was talking with the Volvo Cars CEO about earlier on. More fallout from the protest blocking truck traffic into Detroit from Canada. This adding to supply chain issues that the auto sector has to deal with. At least 6 auto factories near the border have slashed output due to parts shortages. The protesters are demanding an end to coronavirus restrictions. Let's get more with Craig Fuller, CEO of transportation and supply chain data firm FreightWaves. Craig, nice to have you with us. So at the margin, are things getting better or worse? Are these protests gaining momentum, or are they starting to fade away a little bit?
Well, I think right now there's certainly concerns that they could be gaining and could be taking, the Department of Homeland Security put out a warning that Super Bowl protests could hit the United States. We could see protests that accelerate through the North American market, and that's certainly of concern. So it's something we're watching. Trucking protests have been something that have taken place across the world, have crippled economies like Brazil and Iran over the past couple of years, and could certainly play out here in North America. Right now, it's something that is fairly isolated to Canada and specifically through the cross-border traffic. But if it does take place across the U.S., it could have a pretty big impact on supply chains.
So how big would that impact be? I know it's tough to quantify, and we don't know if it's really going to happen. But how concerned should we be, Craig, about the possibility of U.S. truckers basically striking?
Well, truck drivers in the United States have always talked a lot about striking, and usually it's over economic insecurities or economic differences where they feel like someone is taking advantage of them for rates. We saw that during 2000, where there was a lot of discussion about the fact that freight rates were so low and freight brokers were, they thought were taking advantage of the drivers. It's obviously that's not a concern now because freight rates are extraordinarily high. Drivers usually aren't incented. There's a lot of noise that builds up to these protests, and they never really take place at scale. We see isolated pockets of protest. We saw a couple of years ago something called Black Smoke Matters, and that was a protest that was against government regulations, but it had limited impact. It was really, really small when it came down to it. So we've never seen a wide-scale protest of truck drivers here in the United States. It is certainly, this protest feels much more about something other than economics and more about just a lot of anger that's pent up among people that drive trucks, and it very well could go into fringe groups.
I do wonder if it's not just protests, of course, it's also labor costs have been high. As we've been saying, it's been hard to get that staff to be able to drive the trucks. I'm wondering if these recent developments, when you see FedEx, Walmart, these types of companies just piling money into autonomous truck driving, do these just speed up what is perhaps an inevitable future?
Well, the protests are unlikely to come from company drivers. So drivers that drive for FedEx and UPS are not the types of drivers that would participate in these types of protests. It's more the independent operators that are typically the ones that are participating, the ones that make a lot of noise. So I would not expect that the UPS and FedEx drivers are the ones that are of concern. When it comes to autonomous trucks, we are still at least 5 years out of seeing point-to-point autonomous. And so I don't think that's a substantial risk. Drivers are still in high demand. They're the actual beneficiaries of high rates, particularly the independent operators. So there's a lot of question whether they will actually sacrifice their opportunity to make a lot of money to go participate in these protests.
Where are the biggest problems, Craig? If you look at the infrastructure in the U.S., we've heard that there is a shortage of truckers to pick stuff up from the ports. There's a shortage of truckers to get stuff on the highways, and there's a shortage in the last mile. Where are the biggest issues?
I mean, I think it's pretty ubiquitous. Certainly the over-the-road trucking companies, the over-the-road trucking drivers are where you have capacity issues. So these are in longer lengths of haul. Anything that's more than a day's travel tends to be the most problematic in terms of finding drivers. And the reason is that it's not so much an economic problem. There doesn't appear to be a price at which you're able to attract employee drivers. It actually appears to be a lifestyle issue, and you're competing with a lot of other industries like construction and warehousing are competitive in terms of paying the same kind of rates as truck driving, but they don't have the lifestyle jobs or lifestyle issues that you tend to deal with trucking. So we think the long haul market is the most problematic for finding labor, and that is creating a big capacity issue throughout the supply chain.
Craig, thank you very much. Thanks for joining us. Craig Fuller, FreightWaves CEO. Interesting to watch the developments on the Canada-US border and the extent to which this inspires other activity globally. Certainly, we are seeing that talked about in France and elsewhere. Coming up later today, Nobel laureates in economics, Paul Krugman. That conversation, 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Anna Edwards and Danny Berger in London. Kailey Leinz is off. In 2021, Ducati motorcycles set a company record for global sales. The U.S. led the market with an increase of more than 30% from the year before. Ducati North America CEO Jason Chinook spoke to me about how they managed supply chain challenges while maintaining growth.
We did have an incredible year of sales. In fact, this has been an amazing year for not only Ducati worldwide, but for North America and the U.S. specifically, because we ended up achieving the status of being the #1 market in the world, which for us is an accomplishment, specifically considering that this isn't our home country.
Yeah, I would think it's Europe, but the U.S. is the biggest market.
Yes, now it actually is. In fact, we usurped Italy last year, which is a personal accomplishment for us professionally as well. But it's one of those things where we always have a friendly competition with our colleagues over there. #1 motorcycle for us has been the new Multistrada V4. And without a doubt, that's just been an incredible motorcycle in terms of how the public reaction has been to it. And this is really the first time that we've addressed the dual sport category seriously and giving us an opportunity to have a really good motorcycle that's incredibly capable both on-road and off-road. And not only do I think that the V4 power plant has been a big part of its success, but the fact that it also has all this incredible new technology.
In terms of the multi, you add so much, obviously 2 new cylinders, but also all the technology. Are you able to make up the costs in a bigger price in the margins?
Absolutely. In fact, it's very important that we do that as well. I mean, the price positioning of the motorcycle has moved up, but also the demand from the market, from the customers have as well. I mean, people want more from us. They want more technology. So it's really not proven to be any sort of an issue for us. And of course, this is a motorcycle that we expect is going to have very long legs. I mean, this is a conquest motorcycle. It brings new people over the Ducati brand that maybe have appreciated us from afar, always thought that we were that beautiful, sexy Italian motorcycle that was not approachable. But this makes it something that they can ride every day. So from a price position, it's important that we are within the competitive segment, but to be able to bring a technology and quality that people are expecting from us.
And that was Jason Chinook, Ducati North America CEO. He used to run Lamborghini here in the U.S., and it wasn't bad being down at the Ducati store interviewing. I'm glad to be back in the States, glad to talk to Jason again.
Yeah, there are worse things you could do with your Thursday, I suppose, than go down and do that interview. I hear there's a big sporting event, Matt, coming up.
Yeah, there is. Nothing to do with motorcycles. We're going to be watching the Super Bowl on Sunday. I'm going to have to stay up extremely late. But Danny, you'll be in the office early enough to watch it from work.
Excellent.
I might even catch the halftime, Anna.
Excellent. I'm actually off on Monday. Such is my level of excitement. I need the day off to recover. This is Bloomberg.